So today's topic is long-term financial management. Fine. So, suppose this is a company. So today's topic is long-term financial management, and let's start from this. So I'm speaking about a company. The company's name is XYZ Company. Okay. So XYZ Company wants to run its business. To run the business, you require finance. Finance, again, I would divide this finance into two types. One is short-term finance, whereby I'm speaking about working capital, which would be used for working capital purposes to run the business smoothly on daily basis and to like and to meet its daily requirements, which is meet its daily financial requirements related to its routine activities. So for that they require working capital. So our agenda today is not to discuss anything about short-term finance. Our chapter is all about long-term financial management. So we'll discuss about the long-term finance. So then comes long-term finance. Long-term finance is very essential for the company to meet its long-term goals, to fulfill its long-term financial requirements. Like in the future, if they want to expand their business, if they want to overtake some business, if they want to buy a plant or and machinery, or if they want to do a very big scale investment, they want this long-term finance. And it is very advisable for a company to run its to like to fund its big time or big ticket investments, or we can say a hefty investment with long-term finance, not with short-term finance. Okay. So since we have understood that company XYZ is a company which requires finance to run its activities, whereby we have also discussed what are the categories of finances they require, and in that the topic, and in that this is what we are concerned with, because this is what we are learning. Okay. So short-term finance is finance which is usually used by the company to run its activities, which may be for a span of 1 year. If they want, if there is some activity which would be a prolonged activity or would go beyond 1 year, then long-term finance is what is there required. Okay. So in long-term finance, definitely what comes in your mind when I speak about long-term finance, or if a company has to, if a company should have a capital structure, so what ideal combination or what should come in that capital structure? Definitely equity share capital is what I'm speaking about. Yes.
Preference share capital.
Then preference share capital, and then comes the bonds or long-term debts. Okay, these are the ones which a company would require as long-term finance. Okay, so these are external funds coming from outside. Long-term debt is what we know what is long-term debt, either taking loan from a bank or either issuing bonds to public. Then comes the preferred stock, issuing preference shares to public, and giving them ownership or stakes in the company. I'm not saying that they are the actual owners, but they also, when like preferred stock is an arrangement whereby it's like a long-term finance. Okay, it's like it almost has very similarity to a bond, because the dividends are given fixed to a preferred shareholder and the shares are also redeemed, but I would not say it's exactly a liability for a company. Okay, so preferred stock reflects the issuance of security with characteristics that make it a hybrid or cross between bonds and stock. That's what. Some features it has of a stock and some features it has of a bond. That means there we will give dividends to them. Okay, dividends are given generally to shareholders. Okay, dividends are just given to shareholders, but these dividends are going to be fixed. which again has some characteristics of bond, because for bond holders fixed interest is what company pays. Okay, so that's what it has, dual characteristics. A preferred dividend is usually paid if it is at all possible to do so. That means if company has profits, then only the preference dividend should be paid. Otherwise, there's no compulsion on company to pay a preference dividend to preferred stockholder. In case of losses, the company is not going to pay any dividends to preference shareholders. But they cannot do the same thing with the long-term when they borrow money from some bank or if they issue bonds to people. Because in case of long-term liabilities or long-term loans, that is not going to be possible, because even though company is in losses, company has to pay at any cost the fixed interest to bondholders. Okay, now common stock, these are the actual owners of the company and they have been given stakes in the company since they bought the stakes in company by buying the shares of the company. Since they bought the shares, they get ownership rights in the company and they get voting rights to appoint board of director who would work for them and who would be their agent in the company. Okay, so common stock, par value of the share means what? The face value. Additional paid in capital is nothing but additional like capital. If company requires, they can issue additional shares to public. Fine. And dividends are paid to the shareholders, equity shareholders, that is after meeting all the obligations. Like suppose if I say PBIT, from that I will remove the interest which goes to bondholders, I get PBT. From that I'll remove tax which goes to government, I'll just take PAT. Again from this PAT we declare some 20% dividends. That means we transfer this PAT to retained earnings, and after transferring the PAT to retained earnings, suppose let's say we have 1 lakh as PAT, of that 20% goes as dividends and 80% is retained in the company itself. Okay, these were the external funds. Now internal funds also, what is that which company has? In that I would speak about retained earnings which company itself has. That means it gets created as the company like is existing. Fine, every year whatever the profits the company earns goes into retained earnings account, and that money can be utilized by the company for reinvestment purposes. So why company retains is what I've already explained you, because not the entire profit cannot be shared with the shareholders. Only some fraction of that can be given to the shareholders as dividends. Now here there are some points related to capital structure. Now let's determine the capital structure. So it is up to management to determine the best source of financing for the company. Yes, the financial manager of the company has to ensure that they arrange finances for the company, and that finance should be the best. Here the best means the least cost finance. The finance, the combination of debt and equity that can be at very least cost. That means it should be very less costly for the company to arrange finance. That means if I arrange loans, if I arrange funds in the form of loan, or if I borrow from a bank, one bank is giving me loan at the rate of 10% interest, another bank is giving me loan at the rate of 11% interest. I should go with 10% interest charging bank. Why? Because that is of less cost to me. That is what I have to see from a company, and that's what I expect from the financial manager of a company. The optimal allocation of financing among different types of capital will be made by taking into account many different considerations, of course. So we will arrange finances based upon various factors. First and foremost, we'll see the future prospects of a company. So will increased level of sales, that is what we are checking the prospects, that if the sales are high, can they bring additional cash to us in the future? Okay, or will there be a need to expand, requiring additional cash? So if we want to expand, we require additional cash resources. Projections of amount and volatility of future cash flows are very important. Yeah, how we would be receiving cash, and how like whether there's a lot of volatility in receiving that cash, we have to see. And if the firm's cash flows tend to be very volatile, that means we don't have fixed cash flows like coming to us. That means the cash flows are very volatile in the sense they are not stable cash flows. They are like sometimes very high, sometimes very less. The firm is said to have a high degree of business risk. As a result, it should be more conservative in its financing sources. That's one. Equity, they can go to equity market and they can arrange the funds in form of equity. Uh, and if at all, it should also be one more thing, that company should get funds from the equity market easily. Not every company would get like funds from the equity market. I mean to say here, not every company's shares are easily saleable in the market. Okay. The composition of companies' assets. So companies tend to finance current assets with short-term finances, short-term sources of capital, of course, and permanent assets with long-term source of capital. Okay. So therefore, if a firm anticipates higher investment in property, plant, and equipment, it will definitely go for long-term source of finance. Now, amount of risk the company is willing to accept. So debts are more risky. Okay. When compared to equity, because there is a chance of default in case of debt, and that is only possible because if more and more debts get piled up in the company comes in lot of pressure to repay these debts, and they can also go bankrupt if enough profits they're not earning every year. Okay. Reputation of issuer, the company issuing securities and the interest rate it would need to pay in order to be able to issue debt. The greater the risk the lender or lenders perceive, of course, when company is issuing bonds to people, if they see that there is more risk in the company, they would demand more returns. So the cost of each source, yes, the company has to see how much cost they are incurring if they are issuing, if they are arranging finance from a particular source of finance. They should always try their level best to reduce their cost. Now, bond securities or debt securities we are discussing first. So you know what is a bond? Bond is nothing but a company XYZ requires funds. So they have lot of assets. The assets are illiquid assets. So they'll be converting these illiquid assets into liquid assets, and like what they will be doing is they will be converting these illiquid assets in form of liquid assets, and that form is nothing but bonds. So each bond they'll be like fixing a denomination of $1,000, and they'll be issuing this to public. So people can buy these bonds. These bonds are again tradable in the market, and company would pay interest on its borrowing from the people. Why company goes for issuance of bonds? Because since the collateral is their assets here, and bank may charge, maybe there can be a reason, like banks may be charging higher interest to the company, so then they would be preferring to issue bonds to public. Interest, the cost of borrowing, the return for investing. See, I always say the cost of capital for a company is equivalent to required rate of return. Just a second. Cost of capital is equivalent to required rate of return. Correct? These two are same things. Correct? So for you, the interest what you are paying to the bank is an expense for bank. That interest it will be interest received. It will be income. Okay. For you, the interest expense is equal to interest income for the bank. So we are discussing about interest. When you borrow, you have to pay interest. That is the cost you incur. Okay. And you are paying interest, that is expense for you. For the bank it is income. So what would bank see before giving you any kind of finance or loan, and how will they decide what returns they should get from you? On what basis they would decide that they should get how much returns from you, or what should be the required rate of return? As you know, we have already done CAPM equation. With that we can find out the required rate of return. But here we are speaking about a debt finance, not about equity. Am I right? Hello.
Yes, sir.
Yes.
Hello.
Yeah, we are speaking about debt finance here. So CAPM won't work here. So first and foremost thing is the base, that is the risk-free rate, RFR. Then we would add the credit or default risk. That means suppose you are a bank, and you are lending money to your client, that is Tata Power. So first of all, there will be a reference rate, there will be a base rate, that is the risk-free rate. Let's say that is US Treasury. Let's say I am not speaking about Tata Power, I am speaking about Apple, let's say. So risk-free rate US Treasury plus Treasury bills, not bonds, you know, understand? Plus Apple can default, of course. Apple can also default. So I'm having a risk, that is credit or default risk. See, if I give money to Apple, I know Apple is a very good company, excellent company. I'm not speaking about that Apple which makes iPhones and all. I'm speaking about Apple let's say Apple is a very good company. Let's say Apple can also default, fine. Why not? Apple, I won't say that. Apple is one of the best companies. I'll say some company's name here. Let's say I'm taking one company, let's say XYZ Inc. and it is a US based company. It can default now. Since it can default, see, if I give loans to them without properly assessing their credit worthiness, from my side it is credit risk, and if they don't pay the amounts to me, why they won't pay? Because I did not assess their credit worthiness properly. Okay, I did not do a proper background check. That was a credit risk. Now that can lead to default risk. If they don't pay the money to me, then they can default. Then I will add the extra premium what I should get for that risk what I'm taking, credit risk or default risk. Suppose RFR is 4%, I add extra 2% here. Then more risks can be there. Liquidity risk, that particular because investors prefer securities that can easily be converted. So see, what happens is, if I am buying like lending money to a company, that means I am buying bonds of that company. I am buying what?
Bonds. You're buying bonds of the company.
These bonds would be maybe converted into cash very easily or not, it's a question mark. So I add 1% extra for liquidity risk. And then I would also see tax status, like in a country I'm investing, like I would like to invest. So let's say I would just conclude here, plus something like inflation risk also I can add, and duration, like if the bond is for a very high, for a very long time, if the lending is for a very long time, that means if I have given loan for 20 years, I would add more to that again. So like maturity risk, I can say. So altogether 4, 5, 6, 7, 8, 9, 10% is what I may expect the company to pay me the interest on bonds. Okay. Now, see, every investor would look into tax status also. See, if you're an investor, you may have some kind of mindset that if I invest in some securities whereby the interest what I get should be tax, should be exempted from tax. That means government should not charge any tax to me on that interest payment or the interest income what I'm receiving from that company. Correct? You will think it or not. Many people think in that way. So there's a question here. Let's solve this. The market interest rate for a AA rated, it's a low ratings what they've got. AA rated 10-year corporate bond on which the interest is taxable is 5%. On the same date, the market interest rate for similarly 10-year municipal bond on which interest is tax exempt is 3.65. So what they are saying here, the market interest rate, so the rate which is in the market right now for a 10-year corporate bond on which interest is taxable is 5%. So market interest rate is 5%. On the same date, the market interest rate for similarly rated 10-year municipal bond, AA bond, municipal bond, Market interest rate is 3.65%. Investor is deciding which bond to purchase. Investor's tax rate is 35%. So these are two bonds, and investor has to decide which bond they have to take. So if company buys the municipal bond, company will earn 3.65 per annum interest and will pay no tax on interest, correct? Because it is exempted from tax. Government bonds. So for investor company, the net return on the municipal bond will be the same as if investor were to earn 5.62 per annum. How? How? See, the investor is getting 3.65, correct? Hello.
Yes, sir.
And
Yes,
this
sir.
is tax exempt, yeah. So suppose their tax exemption would not have been there. Suppose, let's say, tax exemption would not have been there. Then what would have been there? So actual returns, what the investor would have earned is 5.62. How? 0.0365 divided by 1 minus 0.35. Okay, or I can say it in this way also. 3.65 is for let's say 75%. How much? 65%. For 100%, it would have been how much? Correct?
Yes, sir.
Hello. So can you calculate and tell me? So what is happening here? See, let's take 100%. Let's take it is exempted from tax, na? So there's no tax on it. So 3.65. Okay. No. If at all, like I have to say something like 3.65 is what I'm getting, correct? So 3.65 is what I'm getting, and what I'm saying here is 5.62. So if this was the if my particular security would not have been exempted from tax, if it would have been taxable. Okay, so if I take this particular 5.62 and if I remove 35% from this, how much I'm getting? 3.65, correct?
Yes, sir.
Yeah. So the general perception is when the security is tax exempted, the returns you get is less. Okay, not more. Because if it would have not been tax exempted, then you would have got 5.62, and from that you would have removed tax and you would have got the same thing. Correct? Now, so if an investor buys municipal bond, company will earn 3.65 per annum in interest and will pay no tax on interest. For investor company, the net return on the municipal bond will be the same as if investor were to earn 5.62 per annum on corporate bond, on which it would have to pay income tax of 35% on interest. Calculate as follows. So from, if I say this is my income 5.62, this is my return, for example, and if I am removing tax from this, I'm getting 3.65, correct? If I wanted, if this is my income right now, or my returns, if I want to go to the previous figure, then 3.65 divided by 1 minus 0.35 would give me what? Correct or wrong?
Yes, sir. Correct.
If this comes here and divides, you get the same thing still, correct? So that's the reason why I got pre-tax return. This is post-tax return, but here there's no matter of tax only. So here I get 3.65, but my actual returns would have been how much if tax would have been deducted? 5.62. Now, therefore, investor will earn more in net after tax interest if it invests in municipal bond, because tax exempted municipal bonds taxable equivalent rate is 5.62, is higher than the rate on the corporate bond 5%, on which investor would have to pay tax. So now, if I have to say if I have to see after tax returns, what I'm making from corporate bond is 3.25, correct? Yes?
Yes, sir.
So the 3.25 is the after-tax interest that investor would keep after paying the taxes on 5% interest paid by corporate bond. And still you can see 3.65 is a better deal. So at the end, what I have to say is 5 I was getting from company, 3.65 I'm getting from municipal bonds. Here, if I remove taxes, I'm getting how much? 3.25. So here I'm getting 3.25 after removing taxes. Still I get more in this, correct? It's a better deal now. So how both calculation result in the same decision, the municipal bond is better investment. However, decision between tax exempt securities and taxable securities is entirely dependent upon the tax rate of investor. Instead of 35%, let's say it is 25%, then you would have got 4.87. Then which one would have been better? AA bond, correct?
Yes, sir.
Yeah, because the tax rates are very high, you got a very high exemption and you got more benefits. Tax rate is less, you get less exemption. So you get 4.87, which is less than 5%, correct? Yeah. So when an investor company's tax rate is 75, taxable bond is better because the taxable, because now see, if I take 3 points, if it is like 4.87, correct? And if the tax rate is like, if I take 5 and if the tax rate is 25%, if you remove the tax rate from this, how much you are getting? 3.75. It is better than 3.65 now?
Yes, sir.
Yeah, that's right. So you have to take into consideration all these factors before investing in a bond. But people will invest in municipal bond. Why? Because it is very safe, and since it is safe, it is secure, it will always give you less returns than the other bond, okay, which is less secure. So now, however, a local government may issue industrial development revenue bonds on behalf of private sector company for purpose of building a factory or acquiring equipment if acquisition would improve the economic and employment conditions of the region. The governmental entity issues the bond but directs the proceeds to private sector company. That means they take funds from the people and they give it to the company. They give projects to the company. The private sector company is responsible for paying interest and repaying the principal at maturity, and the sponsoring government entity has no liability for repayment. The sponsoring government entity holds the collateral until the bonds are repaid in full. Many times the bonds can qualify for tax exempt status. So borrowing company receives the benefit of lower interest because of the bonds tax exempt status. So what happens, these kind of companies which are sponsored by the government, whatever the taxes they are paying to people, okay, the company, the sponsoring governmental entity holds the collateral. So what happens is, see, the government is borrowing, correct? Since the government is borrowing from people, they have to give what to the people? Collateral. Am I right?
Yes, sir.
See, this is government. This is XYZ company. Government is raising funds and giving to this company. So now what actually, instead of government, this company would have issued bonds to people by what? By giving their assets as collateral in the bonds, correct? Without assets as collateral in the bonds, people will not invest in this company. Why? Because they want asset backup. That assets are all with whom? With government now. Because government, people will believe in government. It's not necessary that they should always issue asset-backed securities. Government itself is a very governments are very safe. Am I right? Like there are some countries where the governments have defaulted, but many a times the government bonds are very safe and secure investments. You can take treasury bonds. Do you think treasury bonds ever the United States government has defaulted? No. So industrial development revenue bonds are what? This industrial development, for industrial development and for making building big factories and all, the what will company, the government do? The local government may issue these bonds on behalf of the company, and they will like raise funds and give to the companies to build factories. Okay, and this will what this will do is the companies will start factories and they will start production, and that will create revenue for the company, and employment and development also would happen in the region. Correct?
Yes, sir.
Yes. Yeah. So the private sector company is responsible for paying interest, and see, bonds are issued by the government, but for whom? For the company. So they have to repay the interest and the principal. And the sponsoring governmental entity has no liability for repayment. See, government is not taking any liability. They just issued the bonds for these people. They just sponsored. Now they should have some kind of surety now. So the sponsoring governmental entity holds collateral until the bonds are repaid in full. So they are holding the company's assets till the time, because they raised the bonds, they issued the bonds, and they raised the funds. Now they don't have a liability, of course, but what they are making, they are ensuring that the company should pay to the bondholders. For that reason, they keep the company's assets as collateral. Okay. So many times bonds can qualify the tax exempt status. That means if you are an investor and holding such kind of bonds, since they are government sponsored ones, so you need not pay taxes on that. So that's a good investment for many of the investors, na? Because they are getting tax exemption. And since there's a tax exemption, I already told you the AA rating bond was paying 5% interest to bondholders, and the municipal bonds were paying 3.65. So they were paying less interest. Why they were paying less interest? Because there was tax exemption facility or benefit on these bonds. Correct or wrong?
Yes, sir.
Yeah. So the same thing, the company which is sponsored by the government, okay, like they would get very good benefit. So the company have to pay less interest to the people, because they are already getting exemption on their interest receipts. Fine. As you see here, the municipal bonds are tax exempted. The rate of interest is less. These are not tax exempted, so rate of interest is high. So since the government is sponsoring XYZ company, they have to pay less interest to people. Why? Because their bonds are tax exempted. So term to maturity is nothing but the time period till which the bond is existing, or the time period till which the amount has to be paid by the company. Suppose XYZ company has issued bonds for 5 years, the term to maturity is 5 years. Until that time, company has to pay interest. Special provisions are call provision. Call provision is what? The companies can call. The companies can have an option to buy back the bonds at a fixed price. What is that? That's called call provision. So when companies issue bonds to people, they issue with this provision that when in future they have some surplus cash, they can buy the bonds from public at some fixed rate. That's called call provision. And there's a convertibility clause also. That means bonds can be converted into equity. This is also there. Okay. So Smriti, we will continue this from tomorrow. Okay. Tomorrow same time shall we take the class?
A little later,
Hello.
sir.
Sorry.
Yes, sir. Yes, sir. A little later, if that's okay.
6:30 would be fine, na? Or else like.
Okay, sir. It's fine.
Yeah, so no problem. Tomorrow what I'll do is like 5:30 is something, I'll call you and Zarina, and I'll fix the time and we'll go ahead. Okay. I was ready from 6:30 only, but we started late now, the class. You did not see the messages. So again now I have to go home. I have to leave from here and go to like my house. like Mumbai, I shifted there now. So otherwise I would have taken this class for 1 hour. So tomorrow, whatever time we fix, we will at dot will start the class. Okay.
Yes, sir.
Okay. So go through this till here. Tomorrow we will discuss about this. Appropriate
Yes,
yield on a debt security. Actually, I have already explained you this one. What is the appropriate yield on debt security? First, you'll start with the treasury rate, then default premium, liquidity premium. Correct or wrong? Why these premiums? Because of these risks. Okay.
yes, sir.
And then premium for tax status. What is this premium for tax status?
Is it
If
premium
the
for
bond
the
which you are buying, okay, carries a higher tax, carries a risk of tax. That means tax would be deducted on that. That means the interest what you are going to get from the company, on that the government will charge tax to you. So you want less returns or more returns now? That risk is there or not? Hello.
risk is there?
See, if the government is charging tax on the interest payments what the company is making to you for the bond which you are holding, so will you adjust for less returns or you want more returns?
No return.
More returns, so premium. If there's no tax or it is exempted, then discount. And then, uh, see, company will issue bonds with special provisions, like I said, call option or call provision. That means company can buy back the bonds at a fixed price, which you don't like. You want to hold the bond and enjoy the returns. Since the provision is there, company can buy it back earlier, then you would like to get more premium for such bonds. Why? Because there's a risk of company buying back the bonds earlier. Am I right? See, if the bonds you are holding for a prolonged time, you get higher returns, na? Since the company can buy back that in a lesser span of time, you would not enjoy the returns for a longer period. So for that, what you will demand from company? You will demand higher returns. That's premium. Okay. And if it is like it's for prolonged time, then you are okay with less returns also. Not a problem. So this would give you yield of debt security. And the next concept is real rate. You know, nominal rate is nothing but which already incorporates inflation. That means when you invest for longer period of time, you know that there is going to be inflation which can impact your returns. Why? Because if company is giving you 10% returns, that is fixed interest they are going to pay for a longer period of time, and in the market there is high inflation, you will not be happy with 10%. Correct? You would want more returns now because of the inflation. Because with less returns, what you're getting, you're not able to. It's not justifying. It's not justified for you. Why? Because less amount you will be getting, or whatever the amount you'll be getting, you'll not be able to buy like things normally at normal rates. Why? Because the things are very costly now in the market. So nominal rate is what you demand when you invest in a particular security for a longer period of time, because inflation is one of the factors which can impact your earnings or returns. So nominal rate is equal to real rate plus inflation. And nominal rate minus inflation is what, Smriti? Real rate. Okay. So here,
Yes, sir.
real rate. So this is what is in the, I have explained you by addition, and the same concept we have already discussed in capital budgeting, that is investment decisions also. So nominal rate when discounted with inflation, or else I'll write it here, real rate is equal to 1 plus nominal rate minus, I'll take LCM, 1 plus inflation by 1 plus inflation. So this minus minus cancel. This will also be minus only. So nominal rate minus inflation is what? Real rate, correct? So see, 1
Yes,
plus
sir.
nominal rate, 1 plus inflation minus 1. So 1 plus nominal rate minus 1 minus inflation divided by 1 plus inflation. So this should be cancelled. 1 nominal rate minus inflation is real rate. Okay. So this is the question you have to do as a homework, finding out the yield on debt security, and tomorrow we will start from here, term structure of interest rates and yield curve. Okay, same time. Thank you.
Yes, sir.